On February 28, 2026, the United States and Israel launched strikes on Iran. Iran retaliated. The Strait of Hormuz, the choke point for 20% of global oil supply, is effectively closed. Oil prices jumped from $67 to over $80 per barrel in 72 hours. And this isn't just a geopolitics story. This is about your money, your gas tank, your grocery bill, your investment accounts, your job security. If you're watching this right now, you need to understand what's coming and what you can do about it before it gets worse. Welcome to Wealth Flow Explainers. This isn't financial advice. I'm not a financial advisor. But I'm going to break down exactly what this conflict means for your wallet and give you practical steps you can take right now. Hit subscribe because this situation is evolving fast. Let's get into it. Here's what you need to know. The Strait of Hormuz is a 21-mile wide waterway between Iran and Oman. About 20% of the world's oil passes through it. Also a third of seaborne natural gas exports. Right now, it's not technically closed, but insurance companies have pulled coverage for ships traveling through the strait. Shipping costs have spiked to 6-year highs. The result? A de facto closure. Oil that normally flows from Saudi Arabia, Kuwait, UAE, Iraq, and Qatar to Asia and Europe is stuck. Brent crude, the international oil benchmark, was trading at $73 per barrel on February 27th. By March 3rd, it hit $80. Some analysts are projecting $90, $100 if this lasts more than 2 weeks. And that oil price spike, it doesn't stay contained to energy markets. It ripples through everything. Let me show you exactly how this hits your money. The most immediate impact you'll feel is at the pump. Right now, average gas prices in the US are up about 10 cents per gallon since late February. Here's how the math works. For every $10 increase in crude oil prices, gas prices rise by roughly 25 to 30 cents per gallon. Oil went from $67 to $80. That's a $13 increase. That translates to about 30 to 40 cents more per gallon at the pump over the next 2 to 4 weeks. If oil hits $90 or $100, you're looking at 60 to 75 cents higher than you're paying right now. What this means for you: if you drive a car that gets 25 miles per gallon and you drive 12,000 miles per year, that's 480 gallons of gas annually. A 50-cent increase per gallon equals $240 extra per year. Not catastrophic for one person. But if you're already living paycheck to paycheck, that's $20 more per month you weren't planning for. What you can do: short-term, combine trips, carpool if possible. Use public transit where available. Medium-term, if you were already considering a fuel-efficient vehicle, now's the time to run those numbers seriously. Long-term, this is a reminder that gas prices are volatile and unpredictable. Building a budget buffer for energy costs is smart financial planning. Higher oil prices don't just hit your gas tank. They hit everything that needs to be transported. Which is everything. How this works: trucks run on diesel, which comes from crude oil. Planes run on jet fuel. To 30% of Europe's jet fuel supply flows through the Strait of Hormuz. Ships that bring goods from Asia to the US and Europe are already being rerouted around the conflict zone. Longer routes mean higher fuel costs. Those costs get passed to you. Economists estimate that a $10 increase in oil prices adds roughly 0.2 percentage points to inflation. We're already at that threshold. If oil goes to $90, $100, we could see another 0.3 to 0.5% added to inflation. What this means for groceries: food has to be transported. Packaging is often petroleum-based. Fertilizers use natural gas. Expect grocery prices to edge up 2 to 5% over the next few months if this continues. What you can do: buy staples in bulk if you have storage space and cash flow. Rice, pasta, canned goods, things with long shelf lives. Avoid panic buying. Hoarding creates artificial shortages and drives prices up faster. Stick to your budget. Track spending more carefully right now. If you have money in the stock market minus 401k IRA brokerage account, you've probably already seen some red. What's happening? On March 2nd to 3rd, US stock markets dropped. S&P 500 futures down 0.8%. European markets down 1.3 to 1.4%. Some sectors get hit harder than others. Winners: energy companies, defense contractors, Gold. Losers. Airlines, transportation, consumer discretionary. What you should not do. Don't panic sell. Every military conflict in the last 40 years has caused temporary market drops. Most recovered within weeks or months. If you sell during the dip, you lock in losses. If you hold, history suggests you recover. What you should do. If you're young and investing for retirement 20 to 30 years from now, this is noise. Keep contributing to your 401k and IRA. You're buying stocks at a discount. If you're close to retirement within 5 years, make sure your portfolio allocation reflects that. You should already have significant bonds cash to weather volatility. Don't check your accounts obsessively. Seriously, daily market watching during crises makes you more likely to make emotional decisions. One exception. If you have cash reserves and you've been waiting to invest, market dips can be opportunities. But only if you're investing money you won't need for 5+ years. This conflict complicates things for the Federal Reserve. Here's the dilemma: higher oil prices equals higher inflation. But geopolitical uncertainty also slows economic growth. You get stagflation risk, rising prices plus slowing economy. What this means: the Fed was expected to cut interest rates in 2026. Some analysts were predicting 2 to 3 cuts. Now, former Treasury Secretary Janet Yellen says the Iran conflict puts the Fed even more on hold. Translation: interest rates stay elevated longer. Impact on you. Mortgage rates. If you are waiting for rates to drop before buying a house or refinancing, that timeline just got pushed back. Credit card rates, already high, averaging around 20%. Won't be coming down soon. Car loans, same story. Higher for longer. What you can do. If you have variable rate debt, consider locking in fixed rates now before things get worse. If you're carrying credit card debt, prioritize paying it down. High interest debt in a high rate environment is financial quicksand. If you're house shopping, don't wait for perfect rates. They might not come. If oil stays above $90, $100 for a sustained period, say 2 to 3 months, recession risk increases significantly. Here's why. Consumers spend more on gas and groceries, leaving less for everything else. Businesses face higher operating costs, squeezing profit margins. Economic growth slows. Companies start cutting costs. That means layoffs. Who's most at risk? Industries tied to consumer discretionary spending. Retail, hospitality, travel, entertainment. Companies with tight margins that can't absorb higher transportation costs. Smaller businesses without cash reserves to weather volatility. What you can do. Update your resume. Right now, not when layoffs start happening. Expand your emergency fund if possible. If you have 3 months save, aim for 6. Upskill. If there's a certification or skill that makes you more valuable in your field, now's the time. Network. Maintain professional relationships. If layoffs happen, your network is your safety net. Don't panic, but don't be complacent. Preparedness isn't pessimism, it's smart. The trillion-dollar question. How long does this conflict go on? Best case scenario. Diplomatic resolution within 1 to 2 weeks. Strait reopens. Oil prices drop back to $70.75. Markets recover. Minor economic blip. Moderate scenario. Conflict lasts 1 to 2 months. Oil stabilizes around $85 to $90. Moderate inflation increase. Mild economic slowdown but no recession. Worst case scenario? Sustained conflict 3+ months. Strait closure continues. Oil hits $100 plus. Severe global supply chain disruption. Recession in multiple countries. Most analysts are betting on the moderate scenario. Why? Because sustained high oil prices hurt everyone, including the US economy during an election year. Political pressure to de-escalate will be intense, but nobody knows for sure. Which is why you need to prepare for the moderate to worst case while hoping for the best. Here's what you can do right now to protect yourself financially. Immediate actions this week. Check your budget. Identify where you can cut $50 to $100 if needed to cover higher gas grocery costs. Fill your gas tank when it's below half. Prices are rising. Don't wait for empty. Review your emergency fund. If you don't have one, start building it now. Even $500 helps. Don't panic, sell investments. Set a rule. No portfolio changes for at least 30 days. Short term, next month. Track your actual spending on gas and groceries. See how much it's actually increasing. Adjust budget accordingly. If you have high-interest debt, prioritize paying it down. Rates aren't dropping soon. Review your portfolio allocation. If you're overexposed to risky assets and you're close to retirement, consider rebalancing. Update your resume and LinkedIn, just in case. Medium term, next 3 to 6 months, build or expand your emergency fund to 3 to 6 months of expenses. Consider fuel efficiency in your next vehicle purchase if you're in the market. Diversify income if possible. Side gig, freelance work, anything that creates a second income stream. Stay informed, but don't obsess. Check reliable news sources once per day. Don't doom scroll. What not to do. Don't hoard. Panic buying creates artificial shortages. Don't make major financial decisions out of fear. No sudden career changes, no selling your house, no cashing out retirement accounts. Don't ignore it completely. This is real and it will affect you. Preparedness is not paranoia. The mindset. This isn't the first geopolitical crisis. It won't be the last. People who navigate these situations best are the ones who stay informed without panicking, take practical steps without overreacting, maintain financial discipline, focus on what they can control. A Ukraine war is happening right now, and it's affecting your money whether you're paying attention or not. Higher gas prices, higher grocery costs, market volatility, interest rates staying elevated, recession risk. But you're not helpless. You can adjust your budget. Protect your emergency fund. Make smart investment decisions. Prepare for job market uncertainty. This situation is evolving daily. I'll keep monitoring it and updating you with practical financial guidance. If this video helped you understand what's happening and what to do about it, hit subscribe. This is exactly the kind of real-world, real-time financial education this channel exists for. Drop a comment. How is this affecting you personally? Are gas prices up where you are? Are you changing your spending? Stay safe, stay smart. I'll see you in the next one.